Okay guys, welcome to this video. This is going to be a video on the Greeks explain. So now you have different on certain brokers, you have different ways that they do their option chain, but it's pretty much the same on all the ones, different ones. You can come here and you can choose what you want to see. So you have delta, gamma, theta, vega, right? Okay. So the two most important ones are going to be your delta and your theta, right? But you know they're so basically I'll explain all of them, right? So delta is what tracks. One second. So delta is what tracks. Wait a second. Why is this doing this? Okay, so delta is what tracks the price of the option, right? So 48 cent, if it says delta attracts it tracks the stock as it goes up and down. That's what will determine the price of the option going up and down. So if you have a if the delta is a 0.48, that means that every time the stock goes up $1, that option will go up 48 cents. Now I'm going to explain what gamma and theta and vega are too, but just though gamma, theta, and vega also have they also track different things. So therefore, every time the option goes up $1 does not necessarily mean the option is going to go up 48 cents. Now, that just means that delta itself will make the option go up 48 cents. And then I'll get to these in a second. And then let's say gamma made it go up 6%, and then theta made it go down 29%, and this made, so you have a bunch of different things tracking the price of it. And then after it moves that dollar, once everything's calculated, then you get a price. So everything's doing their own little thing, adding, taking away, depending on how the stock moved. Different things are adding to it. Theta's taken away, so that doesn't, it moves $1 doesn't mean it's going to go up exactly 48 cents, but the delta will make it go up 48 cents, and that's with all, not anything else, included. So this by itself will make it go up 48 cents if these weren't here, I guess you could say, theoretically. So anytime you see a delta, you have 0.48, right? Now, as you can see, the further out of the money you go, right, it has lower deltas, because this right here, look at this as a big, right at the money, that's a big gravity force field. Look at it like, so the further out of the money, they're going to be cheaper because you have a lower delta, right? And it's not that close to at the money is this big gravity, that's sucking them in, right? So when they're further out like this, the gravity doesn't have that much force with them. They don't really care. It doesn't really care about it, but as you get closer to that force up here, closer to the force, then you start to get in their range of pull to where the options started getting affected more, then this force of gravity, so to speak, starts tugging on them more, and then the deltas go up higher, things like that. And then obviously your theta gets a little higher, everything starts to go up. You start seeing the price go up. They're cheaper down here for a reason, right? But as they get closer to at the money, then your delta and stuff will go up. So then you have gamma. So gamma measures, right? So gamma measures the hold on. Oh, why is it doing? Stop. Okay, so gamma is what actually tracks the delta. So the amount that remember, it's lower down here, and as it goes up, delta goes up with it. So gamma is what determines how much the delta will go up every dollar it moves. So the delta right here, the delta is 48 cents, right? So that means every time the stock goes up, it'll add 48 cents on it every dollar, right? Well, down here it was only at 3 cents. So gamma is what decides how much this changes as the option gets closer to at the money, right? a lot of these things aren't really that important, guys. Like when I get into stock, I'm just going over it so you know. Then you have theta. Theta is the most important one. The reason theta is so important because, that's because that's the one that tracks time decay, and time decay is so important because it'll get people to blow up a lot. These are the main ones I want to go over, because if you're not prepared to what theta can do, you will get burned on pullbacks. And if you're trying to swing trade, people think you can swing trade weeklies, but what happens is you'll just get burned. So what you have to keep in mind, guys, is every day that you hold this stock overnight, it's going to take away 29 cents, right? When you hold this option, this 149 option, 29 cents. And then when you get closer to expiration, it gets even worse. So if you're on a Monday through a Wednesday, you would be okay trading a weekly. But when you get to like a Thursday or a Friday, a simple consolidation in the stock, the stock may not even, if you're long the stock, and the stock may not even pull back, and it may just consolidate a little bit like so. If you were trading a weekly option, it expires Friday. It's a Friday and it expires that Friday. Well, if you got long right here, and you got caught in, say you got long, you're right here. You bought it off this VWAP bounce and you got long right here, and you got caught in this chop. Well, look, the stock right here is at the same spot that where you got in at. But I can promise you, if you were on a weekly contract, the time decay would have ate away at that option, and you would be down. Even though the stock is still at the same spot that you bought it, you would still be down. So this is so important when trading weeklies, and people just don't understand this. You've got a position. You have to always look at it like worst case scenario, right? So if you're gonna try to get in a weekly, you need to be prepared to know that time decay is very much going to affect that, even on a Monday, but not so much on a Monday. But if you want an option to move the same way the stock does, like let's say that you get in here and it makes this pullback, and that's not that big of a pullback. But if you were in a weekly on a Friday, the option, if you bought right here, or even if you bought right here, the call option, and it came back to right here, and it came back right to where you got in at, the call option might be 25% lower than where you bought it. And you're wondering how. Well, that's because you're trading a weekly on day of expiration. So you just need to basically tell yourself, if you're going to get into a weekly contract, you need to be prepared. Use predefined risk as in your favor, right? If you're going to trade a weekly on a Friday, you need to look at it as a lotto play. That's why they call it lottos. So options have predefined risk, right? You can only lose as much as you put in, right? And if you buy an option for $2, the most it can do is go to zero, right? So if you buy one contract for $2, the most you can lose is $2. Well, you need to look at that. That's how you need to go into these lotto plays trading weeklies. You need to go into it. Now on a Monday or Tuesday, of course, you can go at it a little different. But when you're trading them on a Friday or even a Thursday, worst case scenario, you need to at least be prepared for it to pull back 50%. 50% from where you bought it. So if you bought it, paid $2, be prepared for it to go to $1 at least. Now, you would be doing yourself a favor by using the predefined risk and be willing to let it go to zero, especially on a Friday, because you need to look at it as a lotto play. You don't go to the gas station and spend your whole savings on lottery tickets, right? No, because your chances of winning are slim to none. No, you go in there and let's say you got $500 in your pocket. You go in there and say, oh, what the heck? What's $10? I'll buy a couple tickets with $10. They're $1, $2 a piece or whatever. I'll buy 5 tickets. $10 is nothing. Or you go in there and say, whatever. I'm willing to lose $100. I just got paid. I'll go buy 50 tickets. If I lose, you're pretty much going into it knowing that you're going to lose, but the reward is there if you do hit, and it's worth the risk to you. You're willing to lose it. You're willing to take the chance that you're most likely going to lose the trade. But if it hits, you're going to win big, right? So that's how you need to look at trading weekly options. Don't go into them thinking, you're going to put half of your account up, and you're going to win all this money all the time. Be willing for it to pull back 50%. And another thing is you want to sell into these quick pushes. You do not want to get caught in chop or pullbacks. You want to take that quick profit on weeklies, and if you do want to try to hold for the bigger move, then sure, you can. If you went into it like I told you, go into it and you're willing for it to go to zero, then yeah, you think there's a big move going and you're like, you know what, I don't care if this thing goes to zero. I'm trying to get that 1,000% winner. I think Amazon's just going to keep tanking or whatever. So this is just something to keep in mind, guys. Theta, just make sure, when you read this, you look at theta and you can see what theta is, but people think that they need to know the Greeks. You don't need to necessarily, every time you get in an option, you don't need to know what all the Greeks are. Now, there are certain strategies that you can do with options to where you do spreads and you sell premium, to where you do need to know like implied volatility and delta and stuff like that. But the way we trade them, as long as you pretty much stay one or two out of the money or right at the money or something like that, you're good. If you're buying a call and the stock goes up, you're going to make money. If you buy a put and you're just buying you want to stay right around here. And I did another video on how to pick a strike, and you could go watch that. But I just wanted to explain about how to trade with time decay as your enemy, because it is your enemy, and you need to know these things if you want to trade options successfully. The best thing you can do if you're going to day trade is on a Monday, Tuesday, and Wednesday, you can trade a weekly. Just, know that it's going to have a little time decay, but you'll be fine on Monday, Tuesday, and Wednesday. But on Thursday and Friday, even on Monday, Tuesday, and Wednesday, trade next week's expiration or 2 weeks out. And then that way, when the stock pulls back just a little bit, the option will pull back just a little bit. It'll trade more in correlation with the stock, right? Instead of the stock just making a minor pullback and then the option making some erratic pullback to where it pulls back 50%, no. It'll pull back just a little bit more in correlation with the stock. So these are all things you need to keep in mind when trading options. If you have any more questions, feel free to DM me or Rock, and we can answer them. So y'all enjoy this video, and y'all have a good day tomorrow. I will see y'all in chat. Okay, guys. Later.